Okay, lovely. Well, hello and welcome to the latest BCIS Construction Outlook webinar. So my name is Richard McLean. I'm the Executive Director here at BCIS. And joining us as usual is our Chief Economist, Dr. David Crossway. Hello.
Morning all.
Bit of housekeeping before we start as usual. So the webinar is being recorded. It will be shared with everyone who is registered. It will also be accessible via our website. If you want to stay up to date with the latest news and insights from BCIS, please do allow our company page on LinkedIn and give us a follow. We've had some questions submitted prior to the session already, which we'll be doing during the webinar. But of course, we do welcome questions throughout from attendees as we go along too. So this is accessible via the little question mark symbol that you can see on the screen here. Any that we don't have time to get to, we will do our best to cover them after the session, and we'll send out the following Q&A with the recording as well. So no one should miss out. Okay, so likewise, just with some of the poll questions will pop up on the screen during the webinar. They can also be accessed anytime via the little graph button icon on there as well. So to allow for questions to be answered right up to the end of the webinar, we won't publish the answers during this session, but we will share the full results with the recording. If any question isn't relevant to you, please just feel free to ignore it and click away or select not applicable. In fact, actually, if you select not applicable, we know everyone's had a read at least. So following the webinar, you'll receive a short survey asking you for some feedback on the session. Please, just a genuine request, if you could take some time to complete it, if you can. To be honest, it just really helps us plan future content, understand how we can help going forward. And then there's also the option to ask questions that you don't have a chance to ask during the webinar itself, or you might think of later afterwards. Okay, so as mentioned, our panel is myself and David. So I'm going to hand straight over to David to run through the agenda. David, over to you.
Okay, thanks, Rich. Hopefully, can move on to the next slide.
Yeah, the button's missing. Bear with me a second. There it is. Great.
Like a few teething problems. Yeah, hopefully most of you are familiar with the agenda, pretty stock standard, really. So we're going to look at the prospects for construction for the remainder of this year and also five years out. And we'll look to do that. We'll look at forecast of future demand levels. Take a look at inflation, both current and forecast. Then get some industry views from our panel members, then draw some conclusions. And as Rich said, we'll take your questions probably throughout this, but also at the end, we've got some that have been submitted previously. So if we move on to the next slide, please. Well, I'm assuming some of you may have heard this term before, and it's one of my favorites. The spectre of stagflation, which is essentially stagnant growth coupled with persistent inflation. And I think that's hovering over the construction industry at the moment, and also probably the wider economy. Unlike more conventional downturns, stagflation exerts pressure from both demand and supply sides. Demand is suppressed by weak growth, which we're currently seeing, while costs remain high due to inflationary pressures from labour and material supply, which we're also seeing, which tends to lead to rising unemployment. And unfortunately, we're also seeing that. So why is stagflation seen to be such a problem? Economists are very fearful of stagflation because once it sets in, it tends to be long-lived and is quite difficult to eradicate. For construction, the result is a combination of reduced workloads, rising project costs, and squeezed margins that end up threatening the financial resilience of firms across the sector. So next slide, please. So today we're going to have a quick look at the current outlook for demand in construction using a combination of BCIS and ONS data. So this chart, grey line is total construction output, the blue line is new work output, and the green is repair and maintenance output. Construction outperformed the wider economy in July, which is good. The latest data from the ONS show monthly construction output was up by a massive 0.2% in July, while GDP was unchanged. So while output growth may have been minimal, at least it was positive after a period of little to no growth since 2023. On an annual basis, total construction output grew by 2.4%, with increases led by growth in new work output, predominantly. And in comparison to July last year, the greatest new work increases were in public non-housing, which was up by just over 16%, and the private industrial output up by nearly 13%. And given positive announcements from the government, we're currently forecasting construction output growth to pick up next year. Much of this growth we're expecting to come from new work output. While we expect repair and maintenance output growth, which has been the main driver since the pandemic, as you can see, we expect that to be more subdued over the next 5 years. However, having said all that, the real test will arrive in the coming months in the lead up to the autumn budget. And I do think we've been experiencing this over the last year and a half, really. Any negative speculation regarding the fiscal position is likely to stall growth as investors wait for clarity. What the government shouldn't do, and I hope they don't, is rein back investment by cancelling or postponing projects in an attempt to improve the public finance position. This would likely stall any fragile growth in construction output going forward. Move on to the next slide, please. So if we take a look at new work, which we expect to be the sector that's showing most growth. As you can see, hopefully you can see the chart quite clearly, but the blue line is private housing, followed by the sort of orange yellow line, which is infrastructure, and then the greyish line is private commercial work. So we're sort of predicting the private housing subsector, which is the largest by volume, has returned to growth after seeing some significant falls in output since its peak. We're forecasting that growth to accelerate from next year onwards as pent-up demand feeds through. But we're not expecting private housing output to reach its previous peak, which is in 2022, until 2029 at the earliest. And that prediction has been pushed back. You've probably heard me say this on a few webinars over the last year or so. We were expecting that to peak in 2027, reach the 2022 peak in 2027. Subsequently, that's been pushed back, and now we're not expecting it until 2029 at the earliest. And that's largely because of what's been going on in the private housing market. Infrastructure output, which as I said is the yellowy orange line, has been declining since 2023 after reaching historical highs. However, given the recent announcements from the government, we're forecasting output growth to return next year and continue quite robustly through the remainder of the forecast period. Overall, we expect output to be maintained, given the announcements for energy, air transport and water sectors, and obviously major work on projects such as HS2 and Hinkley Point C. Having said that, future output levels in infrastructure are going to be conditional on the availability of private finance for schemes such as the Lower Thames Crossing and the HS2 Old Oak Cumberland to Euston link. And obviously a lot of other projects that have been flagged for private finance in the infrastructure pipeline. So there is a fairly big caveat in terms of forecast output in infrastructure sector. It's certainly going to be reliant on private finance. In terms of both commercial and industrial sectors, we're sort of looking at really not a lot of growth, only marginal growth over the next 5 years. However, recent data center construction announcements may change this position, and we need a bit more clarity on the announcements from following Trump's visit last week. That was all positive, but how long it will take to get those projects off the ground remains to be seen. Given the state of the public finances, we're not expecting significant growth in public housing and non-housing over the forecast period. Overall, we're looking at new work output growing by 18% over the next 5 years, which is broadly similar to our previous forecast. If we move on to the next slide, please, which is R&M. Sorry, we're on that slide.
I've already done it. No.
Yeah, you've anticipated, right? Yeah, after a period of significant growth, repair and maintenance output has fallen, largely as a result of cost of living and public finance pressures, which are persisting. Public housing repair and maintenance remains subdued over the entire forecast period with virtually no growth, while the much larger non-housing repair and maintenance sector shows a declining output from its peak earlier this year. Although we are predicting recovery next year, followed by some growth through the remainder of the forecast period. And some of that will be down to the regulated sectors, which have definitely got to focus on maintenance and renewals rather than new schemes. In addition, through the remainder of this year, we're predicting a return to growth for private housing repair and maintenance before output falls next year and then cycles through the remainder of the forecast. Overall, total repair and maintenance output is forecast to grow by 10% over the next 5 years, which is slightly less than our previous forecast and significantly less than our new work forecast. Public spending is going to remain constrained throughout the forecast period, and it's going to impact growth in public housing, public non-housing, and infrastructure repair and maintenance over the medium term. So that's sort of our quick run through of output forecast. If we have a quick look at new orders now, what a messy chart, so apologies for that. According to the latest ONS data, total construction new orders fell by 8% in the second quarter of this year compared with the first quarter. There were £11 billion worth of new orders placed, but on an annual basis, this represented a decline in orders of 12% on the same quarter last year. And a fall in new orders is often a precursor to a shrinking pipeline of output in future, although the correlation between orders and output is not often as simple as that for some reason. The latest data points to declines in commercial, industrial, and infrastructure orders. And I think some of that may be symptomatic of the lack of clearly defined private finance routes in the infrastructure strategy and pipeline. And really the sector, I think, and investors in particular, really need the detail so that they can get their checkbooks out. But we're still waiting for that. Hopefully the budget will provide some clarity. Next slide, please. So as last time, the short-term outlook is reasonably positive. There's no red on this chart. However, the state of the public finances, combined with the relatively unfavourable investment climate, is continuing to negatively impact growth in some subsectors. There are some bright spots. So new housing, as we've touched on, infrastructure and housing repair and maintenance, all expected to grow. But growth in the other subsectors is expected largely to be flat throughout the remainder of this year. But the prospects going forward appear to be slightly brighter than they have been, all things being equal. Right, if we move on to the inflation piece, we look at the current inflationary drivers using BCIS cost and price data. So first up, we look at the growth in BCIS building costs and tender prices. And you can see, hopefully from the chart, the tender price growth, if you move on.
Oh, sorry, yeah, I've just, the buttons disappeared, David. I'm just, There we go. Great.
Yeah, tender price growth, as you can see from the chart, has not kept pace with the growth in building costs. And contractors are therefore finding themselves in a precarious position. Clients are increasingly resistant to higher tender prices in a stagnant economy. But contractors cannot keep absorbing rising costs indefinitely. Margins, already thin in many parts of our industry, are being eroded further. So quarterly growth in tender prices, as measured by the BCIS all-in TPI, increased by 0.7% in the third quarter of this year, which resulted in annual growth of 2.5%. Growth in tender prices has been slowing, and it's not expected to pick up until the end of next year, with growth remaining relatively flat throughout the forecast period, largely as a result of the prevailing market conditions. Tender prices overall are forecast to rise by 16% over the next 5 years to the third quarter of 2030. It's a long way off. Building costs, as measured by the BCIS General Building Cost Index, increased by 1.7% in the third quarter of this year, resulting in annual growth of 3.5%. Similar to the last quarter, inflation continues to be driven by increasing labour costs rather than materials cost increases. Overall costs are predicted to rise by 15%. With labour costs remaining their main driver into next year, before labour cost growth stabilises midway through 2026. So if we have a quick look at the growth in BCIS input costs, construction is acutely exposed to cost inflation. Materials and labour account for the majority of project expenditure, and both remain under pressure, with significant increases evident since the pandemic. And this slide shows growth. It's important to note that there's been no deflation in materials and labour costs. So growth may be slowing, but that growth is baked in from the pandemic. So it's fair to say that materials cost inflation has moderated from the peak in 2022. Materials costs remain significantly higher than they were at the start of the decade. Similarly, with labour costs, currently the key inflationary driver, due largely to earnings growth in construction, which remains above the wider economy inflation. Muted growth in materials cost inflation continued into the third quarter of the year. BCIS Materials Cost Index is forecast to grow by 0.2% in the previous quarter and by 0.5% in the 12 months to the third quarter this year. We expect materials costs to maintain their upward trajectory through to the end of next year before they stabilise at around 3% growth through the rest of the forecast period. So we're predicting material costs will grow by 16% over the forecast period, which is out to third quarter 2030. The BCIS Labour Cost Index increased by 2.3% in the third quarter of this year, and that resulted in 6.4% annual growth. So you can see that labour costs are growing significantly faster than materials costs. We're forecasting labour costs to grow by 15% over the forecast period. Similar to our previous forecasts, the risks to these, both labour and materials, remain on the upside, particularly for labour, as skill shortages are still prevalent in the market and will likely continue to constrain future demand levels until they're addressed. One of the pre-submitted questions is about that, so we can tackle that in the questions section. Yeah. So we just mentioned earnings. So this chart shows growth in construction earnings versus the CPI. And you can see that construction wages, as measured by ONS's average weekly earnings data set, increased by 4.3% in the year to the second quarter of this year. However, on a quarterly basis, the rate of increase appears to be slowing. Wage growth is still running at above inflation levels, but we expect some stability in wage growth going forward, although it's likely to depend on any wider inflationary impacts. While it's natural for pay to fluctuate, the ongoing decline points to a cooling in the jobs market, and I touched on in the introduction that unemployment was rising. And this is also supported by new vacancies data from the ONS that shows job vacancies in construction between June and August of this year were down by 25% on the same period last year. So we are seeing some impacts, and I think some of this is probably down to the national insurance increase, which has certainly spooked businesses, I think, going forward from April. Next slide, please. If we now look at market conditions, this slide shows the market conditions index, the BCIS MCI, which is the relationship between costs and prices. And it's forecast to decline by 0.6% in the third quarter of this year compared to the previous quarter, which results in a 0.7% fall overall when compared with the year earlier. When this index is rising, prices are rising faster than costs. And when it's falling, costs are rising faster than prices. So we're still seeing costs rise marginally faster than prices. And as seen in the previous slides, input costs are likely to lead tender prices until next year, when we're predicting some recovery towards the end of 26. Okay. So next slide, please. That's a lot of data to take in. I appreciate that. And there's only so much that data can tell you, especially considering the lag in producing that data. So we'll now look at some of the comments made by members of our industry panel at the latest meeting, which was last week, just to get an understanding of current conditions on the ground. So they, as usual, we've sort of got a couple of subheadings on these slides. We essentially are asking for information in terms of what might be driving cost and price increases. So looking at procurement, the panel was slightly more pessimistic this quarter compared to last, although still reasonably positive in terms of getting contractors to tender. The risk of volatility is still being priced into fixed price contracts, particularly ones with a long program. Two-stage routes were still showing higher increases. However, they were seeing less resistance to the use of single-stage procurement outside of the major markets and London and the South East region. Looking at trades, the MEP, mechanical and electrical plant market continues to be in demand and pressured, but to a lesser extent than a year ago. Someone else noted that the pull of mechanical and electrical towards data center work could lead to difficulty securing competitive M&E contractors in other sectors. And given the announcements last week, I do think that may well come back to haunt us. I think with the amount of data center work that was announced, I think there could be capacity problems in that sector. Finally, on trades, new build housing contractors were looking into remediation opportunities due to the volume of work provided by registered providers. So a switch from new work to remediation. If we move on to the next slide, please, Rich. Take a quick look at sectors. Residential bids getting more competitive due to the lack of work. It's reflected in falling prices for some concrete works and rebar. Another mention of data center. The scale of data center work is massively influencing the market for MEP activity. In other sectors, such as residential and commercial. And finally, in sectors, the introduction of the Future Home Scheme has increased the cost of residential buildings, and with it, the need to meet increasing specification has impacted the supply chain and increased inflation in the sector. Project size, risk aversion along the supply chain continues as contractors opt for smaller, simpler projects to mitigate cash flow exposure. Reluctant to go to lump sum model or design and build, moving to target cost or cost reimbursable models where the client is in control of the design. And this is something that came up fairly regularly actually in the panel. Small projects or simple trade packages have good supply and are therefore more competitive. Larger projects, which are fundamentally tier 1 projects, have more constrained supply and are less competitive. So finally on this section, if we move on to logistics, and this has been a recurring theme, I think, over certainly the last few webinars. The Building Safety Act in relation to high-risk buildings. Effectively, the big risk milestone has moved from planning award to Gateway 2 approval. So that's increasing clients' levels of at-risk funding before they know that they have a viable product. And this situation doesn't appear to be changing anytime soon. The backlog appears to be getting bigger rather than smaller, despite the government's attempts to move the approval from the Health and Safety Executive to a dedicated body. But there are still real problems with the BSA. Another concern was accessing connection to the grid. It's proven to be a growing concern. I'm not sure it's just the grid. I think it also relates to water and sewage as well. One panel member noted that seeing a shift in preliminaries composition as more staff time is spent on ensuring regulatory compliance with the need to meet Building Safety Act regulations and complying with tightening building standards, aiming to, and this is their words, not mine, aiming to ensure more onerous net zero targets are met. Just before people start putting their hands up. And finally, from the panel, performance bonds remain expensive and scarce. Most mature clients are seeking different forms of security assurance. So that's a sort of summary of our industry panel's views on the ground. And I do think that the recurrent theme is in relation to the Building Safety Act. And it really is a blocker in the residential sector. Okay, if we quickly summarise what we've looked at today in terms of demand and inflation and comments from our industry panel. So the outlook for construction predicted to grow robustly in 2026 and over the next few years. I think the remaining quarter of 25 will probably be a challenge. And I'm not expecting, because of the late date of the budget, for there to be too much movement for the remainder of this year. So all output looks positive. However, as we've seen, orders are declining, which could negatively impact demand going forward. We move on to inflation. Building costs are increasing, largely driven by increasing labour costs. Tender price growth is stagnating, but I guess the question is, for how long if demand picks up next year? Materials costs are still increasing, albeit slowly. And labour cost increases have picked up, but we're expecting them to slow as the wider economy picture worsens. So I think slightly less positive than last time. If we move to the next slide, please, Rach. So what next? I think the data tells us the picture has changed. significantly since our last outlook. Things do appear to be more negative. Having said that, government announcements regarding construction were broadly positive, with significant investments in built assets announced. However, since those announcements, they haven't really translated into increased demand. Maybe I'm being a little bit too pushy, but I would expect to see investors getting excited about things. I mean, obviously the Gatwick approval is good, but we haven't yet heard from the investors at Gatwick whether or not they're prepared to accept the new challenges placed by the government. So slightly more negative, and I think there are some serious challenges remaining. Not least how to attract private investment to fund future projects, particularly infrastructure projects. And something that I wish had been not pushed back to the end of November, but the outcome of the budget does appear to be fairly high up in people's minds. I think we should have had that sooner rather than later. That does appear to be having a negative impact on sentiment more generally. Okay, that's our quick canter through the outlook for construction.
Lovely. You can take a
Hopefully
breath.
not too pessimistic.
Great. Okay, so just before we dive into the pre-submitted questions, everyone who's been answering the poll should have probably seen that we've been asking what single government action would make the biggest difference for construction over the next 12 months. So I'm curious to get your take on that, David, but also what you expect, if anything, for construction in the autumn budget.
I mean, I think it's going to be a real challenge for the government. They've really painted themselves into a bit of a hole, I think, with what they said in the manifesto. I mean, if you look at the questions that have been asked on the poll, in my view, and say that I will say that now, all these opinions expressed now are mine, rather than necessarily BCIS's.
And that's legally binding. Thank you.
So I think question 1, 2, 3, and 5 are essentially non-starters because of the government's fiscal position. So my choice would be question 4, to reduce the cost of doing business. So I'd be reducing business rates. I'd probably reverse the national insurance change they made as well earlier in the year. And the counter to that would be that I'd increase personal taxation to pay for it. And I know that probably won't be particularly palatable for a lot of people on the call. But essentially that is, historically, that's been Labour's remit. They've been a tax and spend party. And I was, you know, I was very surprised to see the manifesto pledge not to increase taxes on working people. We can't continue to tax businesses because that's the source of investment. That's the source of growth in the economy. If we make it more challenging for business to invest by increasing their costs, I think we're doomed. Not to put too fine a point on it.
I mean, do you think the government should prioritise broad support for all businesses across all sectors so the industry can grow within? Or
absolutely, yeah.
Okay, I don't even need to put the second part. Right, go.
yeah. I don't think this is construction specific. I think it's wider economy. So yeah, absolutely. And I think that there is starting to be a call, if you look at press coverage, for them to go back on what they put in the manifesto pledge. But it's going to be a difficult call, however they choose to do it, because obviously their opponents will be saying, well, you essentially put something in your manifesto to get elected, and you, wanting power, you've gone back on it. So it will be. I don't envy Rachel Reeves. It'll be a real challenge. And my fear is that perhaps she might be the scapegoat for what they intend to do in the budget. Once it's put through, the position may become untenable.
Oh, well, we'll review this comment in the next webinar, I guess.
Yes.
Okay, great. So we're going to go on to some of the pre-prepared questions now, everyone, and then after that we'll try and tackle. We've had quite a lot of questions in already. Please keep sending them through, and so we'll try and tackle as many as we can. But if not, we will follow up afterwards with a recording. So without further ado. Okay, so following the cabinet reshuffle after the resignation of Angela Rayner, the main driving force behind the housing initiatives, do you think the target of building 1.5 million homes in 5 years will be met? And I'm already laughing because I think I already know what you're going to say there. But
another massive manifesto mistake. Yeah, I mean, the short answer to the question is no. It won't make any difference. In my opinion, the target was always aspirational rather than realistic. You only have to look at the historic data on new homes completion, and that would have confirmed that the average number of new homes completed in a year over the last 50 years is 240,000. So multiply that by the length of the parliament, which is 5, and you get somewhere in the region of 1.2 million new homes built. So, around 300,000 under their target. That's probably, a good in a good scenario. But given the latest data, I suspect they may be somewhere off hitting even that, unless there's a massive surge in new housing over the next 4 years. And fundamentally, that will be down to property developers, who obviously control the supply of new housing. And I think you flashed up on the screen a couple of examples of what major house builders have been reporting at the end of their financial years. And there's mention of reform to the planning system, removing barriers to investment, supporting first-time buyers. And I think that really is probably crucial. First-time buyer support has been something that's happened in this country for a couple of decades. And without that, at the very start of the market, the thing that tends to spur all other market transactions in housing, first-time buyers, they've virtually disappeared from the market. So I do think the government are going to have to look at introducing some sort of support for them. Yeah, planning system under-resourced, despite the government's attempt to hire 300 new planners. I'm not sure where they came up with a number for 300, but I'm sure there was some algorithm behind it.
Well, I hope so anyway.
So no, the target is still never going to be hit.
Great. Well, that was pretty to the point. Brilliant. So do you feel the lack of skilled workforce is having a detrimental effect on the industry?
I mean, obviously the perceived wisdom is yes. And labour shortages may be acting as a brake on demand and output growth. But in my opinion, and this is very much my opinion, it's a bit of a chicken and egg situation. You have to ask, is demand being constrained by a lack of workers, or is demand being constrained by other factors, i.e. Uncertainty leading to a lack of confidence, which we've certainly got, relatively high cost of borrowing, and a lack of investment. Now, my view is that all those things are constraining demand rather than a lack of labour. I mean, what's irrefutable, though, caveat that, if you believe the ONS data, is that there are now 500,000 construction workers less than there were prior to the financial crisis in 2008. But on the flip side to that, those workers are delivering more output than they did in 2008, which suggests that output per worker has increased in the sector. which is a good thing in an industry which is deemed to have poor productivity growth. So on this slide, you can see a significant uptick in the labour productivity ratio. Productivity measures how much output is generated per unit of input. And historically, construction's been regarded as having low productivity relative to other sectors, although measurement problems are significant, really. So crudely, I've just taken output and divided it by total employment to see the trend in output generated per unit of input, which is essentially the labour productivity ratio. And the data suggests that ratio in construction has improved significantly since the financial crisis. In other words, we're getting more output for less input. And you can clearly see on the chart that the drop in the ratio after the financial crisis and also the pandemic. But since the pandemic, the ratios, you can really see it, it's increased steadily and is significantly higher than levels recorded pre-pandemic. So I guess the question is why might that be? My suspicion is that this is largely the result of the makeup of sectoral output, specifically infrastructure output as a share of total output has increased from 6.6% in the first quarter of 2007 to 14.4% in the second quarter of 2025. Infrastructure construction is generally much more mechanised than general building, with far greater use of prefabricated components and higher rates of plant and machinery use, and as a result is much more productive. And I guess that, given the amount of new infrastructure work in the pipeline, careful scheduling is going to be needed to avoid capacity bottlenecks. So going back to the original question, I'm not sure it's having a detrimental effect on the industry. I guess the real test of that will be when demand picks up, and then we might start to see some capacity problems feed through. But currently, I don't think there are enough.
Great, lovely. Thank you, David. Okay, I'm glad we've had this actually, because we do get a lot more small to medium-sized businesses questions recently. So yeah, good to address. But what would be your best 3 tips for the viability of small and medium-sized businesses in the current economic conditions of the construction market?
I'll be flippant and say change industry. No. No, I didn't mean that. That was completely unhelpful. I mean, there are steps businesses can take to build resilience, better forecasting, early risk management, and really good communication across the supply chain. I know our industry tends to be regarded as adversarial, and I think quite often it is. But clients and contractors really need to work together on setting realistic programs, fair risk allocation, and careful cost planning to reduce the risk of project and/or business failures. I mean, my 3 tips would be, although it might seem tempting, don't diversify from your core market. And the reason for that is you'll be at a disadvantage to incumbent firms already operating in that market. You'll be exposed to unfamiliar clients and unfamiliar projects which may have a higher risk profile. And what tends to happen when firms diversify in our sector is, as a new entrant, the tendency will be to bid low to win work, because you're competing against established businesses in that sector. And bidding low is never a sustainable option. I mean, you only have to look at, ISG is a classic example of that strategy that went horribly wrong. So what? Yeah. First tip: don't diversify from your core. Second tip is offer a value proposition to clients, which might persuade them to circumvent a protracted tender process, and possibly pursue a single source negotiation approach. That's probably easier said than done, but that would be my second tip. And the third tip is essentially about money. I mean, cash flow for construction business is critical. So make sure you get paid on time. Insist on a project bank account being set up to ensure that sufficient funds are ring-fenced and available for the duration of the project. You quite often hear of clients, and actually this has happened to me personally, clients going bust during the build process because they can't get access to capital to fund the build, and obviously that has a massive knock-on effect on suppliers, not only the main contractor but also obviously all the subcontractors in the supply chain. So yeah, make sure you get paid. Cash flow is critical.
Brilliant, lovely. Thank you, David. Okay, final one, I believe. So, spring budget, spending review, pipeline, strategies, autumn budget, through a succession of announcement and fiscal events. What should construction firms do just to get on and build if we can't rely on economic stimulus from the government? If you've actually got the answer to this one, David.
Right. Yeah, I'm not sure. I'm not sure I have. I mean, yeah, I think we touched on this during the bulk of the presentation. Government initiatives to stimulate growth don't appear to have had any immediate impact, although they've, essentially they've been positively received by the industry. Nothing seems to have translated into increasing output. I mean, I've been in the industry for 3 decades, but I haven't seen anything quite as challenging as the conditions that the sector has experienced over the last 5 years. And I think I do think that we forget what we lived through. I think it was always going to be a struggle recovering from the pandemic. And if you think back to lockdowns and lost output, yeah, I mean, we're now experience the after effects of that, and my fear is that we're going to experience them for a few more years yet. The problem really for construction firms, unless they're speculators, property developers, so contractors essentially, is that they build to order for a client. So if clients don't want to or can't build, then contracting firms are stuck with no work. And at the moment, there seems to be a persistent wait and see attitude from private investors. But fundamentally, I'd say it's time for investors and clients to accept the new normal and just get on with projects. And we did hear that from some of the panel members, saying that they were starting to see more engagement from clients and investors who were basically just saying, we need to get on with this. The long-term position is probably not going to change significantly. So if we need to build, we just need to build. I mean, my plea would be, don't wait for the outcome of the budget, as the next excuse will be it's nearly Christmas, so we can't do anything until next year. Yeah, I don't think that really answered the question, but
I think it was a bit naughty to have it in the slides, to be honest. That's I think if anyone's got the answer to that, there'll be a job offer in the morning.
Yeah, absolutely. Indeed.
Great, lovely. Thanks, David. Right, okay, so we'll jump on to some questions. I'm just going to give a cheeky reminder for everyone on the polls as well. If you could spare a couple of minutes just to answer the poll questions for us, that would be greatly appreciated. As I said, it really does help us to drive content. So yeah, just a shameless push on that. And now we'll go on to a couple of the questions while we've still got time of what we've had so far. I think while we're still on the topic here, but so first question is, what further initiatives do you foresee applicable to shorten the skilled labour shortage within the industry?
Well, that implies that there is a shortage. I mean, the government's announcements about training initiatives, I think, are completely welcome. But the problem with those is that they'll take some time to produce people that can be used on site. So my view is that we still need overseas labour. So I know this is probably not going to be particularly PC, but yeah, we need, our industry historically has relied on migrant labour to deliver during capacity problems, and based on high demand levels. So my view is that we probably need to go back to that, but obviously Brexit has really complicated the issue.
Yeah, definitely. Great. Okay, lovely. I mean, this was ultimately going to come up, but yeah, is there any sense of what impact Trump's tariffs will have on materials costs?
I think minimal is the answer. We had, I think on the last panel, we had one member who said they were experiencing some uplift on components being imported from the US, but that was the exception rather than the rule. So to be honest, I think a lot of it has been blown out of all proportion, a bit like quite a lot of news that we see currently. Probably something to do with trying to fill a 24-hour news cycle. That anything particularly small is blown up out of all proportion. But yeah, I to be honest, for the UK, I don't think the impacts have been significant.
Great. Okay. That has been slightly duplicated with another question as well, just with regards to tariffs, but I think you've covered that. So given the timings for the future home standard are still uncertain, can we reasonably say that this is already feeding through to construction costs? How much uncertainty on the standards increasing costs?
I think that did come up in the one of the panel comments, wasn't it, about increasing regulation having an impact on not only on costs, build costs, but on preliminaries as well. So I ultimately, I think all those initiatives will be inflationary. The question will be what the quantum of that inflationary uptick would be. But absolutely, that they're likely to increase costs.
Great. Okay, lovely. Next question we've had in from Ashley Barnes. So what are your thoughts on stamp duty changes to ensure the housing market keeps moving and does not stagnate, the stagflation environment, I should say?
I hate all government intervention in markets. I'm a bit of a free market person. So the issue for me is that these things are leaked to the press and then speculation builds. And at the moment, that is completely, the speculation about what's coming in the budget in terms of potential stamp duty changes has completely killed the housing market, which probably won't recover this year as a result. So I wish governments, if even if they're thinking of planning changes, would just keep these things to themselves until they're announced. There are unintended consequences from these leaks, and whether or not the leaks are true or not, that's another question. But yeah, I'm not a great believer in stamp duty changes, frankly. I'm not a great believer in stamp duty, full stop.
No, I don't think any of us are, really.
Yeah. But yeah, I mean, the talk of moving the burden, from seller to buyer, from buyer to seller rather. That's like I said, it's had a massive impact on the market. So yeah, I'm not sure what they're going to come up with in the budget.
Okay, lovely.
Lots of words, right?
Pardon, sorry, say that again, David.
I'm lost for words, frankly.
Great. We've had a few questions in from Shea just regarding the number of project samples and the factors we've used. So, Shea, I think we'll address those in the wrap up just so we can give the full BCIS response. I wouldn't expect David to have them handy, I don't think. So we can do that in writing for you. Okay, so next question we've had from Oliver Scott. So what key factors are contributing to continued labour and material cost increases other than general inflation, and why are these expected to tail off or increase in the future?
If we tackle materials first, I think a lot of it is, some of it will be tariff related, but a lot of it I think is energy related. So any component that's got high energy content in its production, such as cement, plaster, concrete, bricks, the cost of energy is still increasing. So businesses are obviously passing that cost on through from producers to purchasers. So that's one of the reasons. I mean, if you know, the counter to that is steel, which has seen fairly significant price declines, and that's largely the result of us importing steel rather than producing it in the UK.
Yeah.
And I think that's probably another reason for cement imports increasing significantly over the last couple of decades. The cost of producing in the UK is becoming far too expensive. So that's one of the reasons for materials costs inflation continuing. Labour cost inflation is essentially a response to wider economy inflation. So as we saw, CPI still relatively high, and wages have been rising to keep up essentially. And that's one of the dangers of stagflation, is that because you've got persistent, relatively high inflation, wage demands are normally above that rate, and it becomes a self-fulfilling prophecy because you end up in a wage price spiral. So prices remain high, and wages essentially try to match those price increases. So it's a very difficult scenario to get out of.
Great. I think we'll keep it. We've got a couple. We'll see what we can squeeze in, but it might be the last. So do you expect the government to focus on new housing delivery to displace labour workers from other areas of construction?
Now, my view is that obviously the government have absolutely no control over the number of new homes to be built, because they don't have any control over the supply. That's private developers' realm. But I did read, I don't know if you've seen Andy Burnham's manifesto. And Andy Burnham is obviously the guy who looks like he might be making a challenge to Keir Starmer. His manifesto had a really interesting piece about home building. He was talking about nationalising property developers, so housing providers, as a way of being able to control supply. So essentially going back to a sort of 1950s to late 70s model where the government, through direct labour organisations, used to build what were then council houses, but obviously now called social housing. And that is the only way the government really can control supply, if they bring the building element in-house.
Great. Okay. Lovely. I think it feels like a natural point to wrap up. So that is all, folks. As you leave today's webinar, you should be redirected to the registration page for our next event, which will albeit will be all about cost and carbon in the built environment. So you can also register it via the QR code I've got on screen at the moment. We've had lots of pre-submitted questions for today's session that we couldn't get to. So I promise we will cover those when we send out all of the questions and answers with the webinar details. So for that next session, two outstanding characters, myself and David, will be there. We'll be joined with James Fisk and Carl Horton. So hopefully we'll see you there. But for now, thank you for joining us today, and we'll see you again soon.